Hey, we're here with the commodity report and got a lot to talk about. It is the end of the year, so we're getting into January 31st, or sorry, December 31st. I'm getting ahead of myself. January 1st tomorrow. So the start of the new year, I kind of wanted to just chat about, what's going to happen next year. And once again, predictions are BS for most of the time. People make a bunch of crazy predictions for the next year, but I also have a lot of fun making predictions because really, like, if you take a look at the data and kind of understand the roadmap that you might be on, it is very helpful for you as a trader to understand those things. Doesn't mean the road's going to be perfect, but I think Kevin and Sam are perfect people to talk about because there could be catalysts both directions. And just kind of laying out the economic landscape, what we could see going forward, what would be things to look out for, and what could possibly affect your trades. So, Kevin, anything you're seeing lately? We were talking just earlier a little bit about China. What's going on with the China situation? You have anything to add on that? And I know you were working on a working on a report. I don't know if you got a chance to finish that, but
I have not.
just generally, like, what are you thinking for next year? I'm
Yeah, I
excited
am.
to hear about it.
I am working on something right now. I just everything's kind of been pulling in every different direction, and Jason and Sam, you guys know how it is, right? You get down, and you're like, all right, let me just craft something, and then you have your bullet points, and then you hit your first bullet, and then your first bullet point is like 3 pages worth of content, and you're like, okay, like I might have bitten off more than I could chew. That's literally what I'm doing right now. Kind of started off looking at you want to talk about China, we can talk about China, right? So from a China standpoint, I think that's the biggest tailwind risk when you're looking at inflation for next year, right? And that's been a very hard trade because people have said the same thing this year and it just has not come to fruition. But I think you're hearing a lot more stronger commentary coming out of leadership there that they are looking to try to spark economic growth. And they only have a few ways that we've seen in the past in order for them to do so, right? They've been kind of dragging a little bit this time around because they don't want to go to the past habits. The past habits have been really aggressive in incentives for real estate and housing, lack of oversight when it comes to those incentive programs and those stimulus measures, which has led to a lot of corruption and now has led to a property crisis there. And so they did not want to kind of go down that route. But unfortunately, they're a big power within the world, right? And they're going to have to go back to what they know. Especially when you're looking at the yuan. If you look at the offshore yuan, I hit a 2-year low yesterday, right? So when people are talking about the amount of stimulus that they're trying to throw into their economy, just got to think about that. That's also depressed currency that's being also pushed into the economy as well, right? So they're going to need to do more on a relative basis in order to really kind of get that impact until they actually start seeing the yuan strengthen here a little bit. Now the yuan is actually it's a pegged currency, but there is also offshore trading on that currency as well. So I think that's going to be actually a potential tailwind for the commodity space next year. That being said, I think we have to put it in the broader context. Do I think that they're going to be the ultimate tailwind when it comes to crude oil and gasoline? I think initially, once we start seeing some of those green shoots, you start seeing import demand starting to rise here a little bit, industrial production starting to gain a little bit more steam. You start seeing 7.5%, 8% numbers coming from industrial production. And you start seeing maybe a small little increase when it comes to crude oil crude oil imports. I think those will be kind of your first 3 factors. I think the market's then going to get those speculators to come in, try to scoop up the Chinese equities, and then scoop up the commodities that are going to be related to that. So that could be crude oil, gasoline, that could also be copper. And then also, in my opinion, I think silver is kind of the best overall beta weight trade that's out there for this. Just because, once again, you kind of have the inflationary narrative that's going to take place there. You got the expansion of economic growth narrative, that could also take place there. You could also have the tailwinds when it comes to the Eurozone, right? The Eurozone hasn't done jack squat when it comes to economic growth. But let's say that does turn around first half of next year. You get that plus a China, expansion story. That's when you get the commodity cycle. I won't say cycle. You get a commodity boost when it comes to prices. That being said, I still think that there's going to be a cap when it comes to oil. The reason being, as soon as prices move up and they stabilize to the upside, let's say that we get back to $80, $85, and we start seeing some stickiness there, what's OPEC going to do, right? Because OPEC has been in a consolidation type of strategy, if you will, right? Kind of constrain supply. So if they do see any type of tailwinds when it comes to economic demand or oil petroleum demand, I feel like they're also going to offset that with additional supply. So I feel like it's going to be very hard for us to have this $100 a barrel oil type of narrative next year, because I think any type of, think of it as like a trailing stop, right? Any type of increase in demand, you're going to also see kind of OPEC say, oh, okay, like there's demand out there, let's put more supply out in the market. And I think that's how it's going to be able to be managed. On the shale side, on oil, you get this narrative every year that you're seeing peak production and all of this stuff. When we see it, that's when we'll know. I don't think you want to get ahead of that trade, because that's been a hard trade to get ahead of. Technology has definitely ramped up and done a lot better when it comes to efficiency rates for wells right now than I think anybody has expected. So I think, and then you also have the consolidation, right? You have basically the major players are now the shale conglomerates out there, right? It's not the smaller offshoots, and then you have potential policy there. So I think that you could get a little bit of a pop when it comes to the energy trade initially, but I don't think it's going to be a sustained one outside of the geopolitical risk type of an event that actually does disrupt supply significantly. That's kind of my thoughts there. And then, I'll kick it back. What do you guys think? What are your thoughts around the China trade or anything that I may have just brought up there?
Yeah, so and Sam, if you have any charts or anything you want to say, feel free to jump in anytime. But just looking at it, so I wrote a bit about China yesterday. So I also wrote about oil last week. Kevin was like, I'm gonna take the opposite of that trade. But no, seriously, this is why I love having these conversations, because it's, once again, it's, I look at the markets in a different way than Kevin does, and Kevin looks at it, and Kevin looks at it in a different way than I do. And because of that, that helps me to kind of understand what the headwinds are going forward. I always want to know what's against the trade I'm possibly putting on. For me, what I'm looking at on the oil trade is I see a massive band squeeze. Basically, volatility is extremely low. But that doesn't mean that it has to move up. I think too many people think when you say band squeeze and you have a band squeeze breakout and the market's going to move up or it's going to move down, like, people want a direction. Really, band squeeze is just telling you that a big move is coming. Up or down, I don't know. I do think it's possibly up. I think there's a lot of reasons to think that it's up. However, I do see what Kevin's saying, which is there's a possibility of just hitting that upside at 85 and possibly stopping there. So I do think that there is the fundamental headwind as well at that level. However, if we're looking at a down, for me, I would have to see a down dollar situation. I would have to see the Fed get a little bit behind the curve, continue to lower rates. Right now, they just raised their inflation forecast to 2.5% for next year. It's just part of the reason why they started to signal that they might have to stop cutting rates so much. So going forwards, I'm still looking at this as, yes, there is a possibility of oil moving up higher. 85 is the next target for me. If we break above the level that we said to buy on, you guys can read the reports if you want to see that exact level. Sam, if you want to drop it in the chat, I can share it to people too. So if I'm still looking at it to move up here, I do think that's a possibility. The other thing, as Kevin said, the main factor being China. I wrote some notes down here because I'm writing a report on China today again. Basically, bond yields contracted at from 1.7%, which is this huge move. If you take a look at the chart for bond yields in China, that's actually a massive move. It was from, I think it was 2.1% to 1.7%. Huge move down very quickly. And their strong exports are masking deeper issues in household consumption. And I'm still seeing that being the case. Like China, it's a tough thing right now. And that's what Kevin and I continue to kind of talk about on this show over and over again, which is the China story is going to happen at some point. Timing it is going to be incredibly hard. And it's always been incredibly hard. But just looking at the idea behind the inflation and the commodities, I think Kevin's right, looking at it like, okay, silver is probably one of the best ways to play this. I definitely think silver is probably the easiest way to play it. It has probably the best fundamental positioning that you could basically hope for if you're going to play that type of a cycle. However, there's a lot of headwinds out there as well. Sam, do you have anything to add on oil,
I'd like
China?
to take the other side of that. I love silver, but what about copper? I think copper could be the better trade. It looks an awful lot like gold. It has that huge multi-decade base. Gold has resolved it, but copper is not. So I think it's a cleaner trade. I think silver could get from like 30 to 50, and like that's cool, but I think you could end up selling copper at $10 or $8. You know, I think that's the
$10 copper.
I think it's possible.
Oh my gosh. Okay, I'll take the other side on that one. I don't think so. Look, the copper trade, I'm right there with you. Copper, there's only a couple of these products that are out there, right? And we're talking a little longer term. Copper is probably the only one that's a three has usually 3 peaks, right? Triple top. If you kind of go back in their cycles, you usually see triple tops before you actually see a massive fade when it comes to copper. Now it is testing a pretty decent area of support right now. Let's say, let's call it 397 and some change if you really care, but let's say $4. Here's the reason why I say, yeah, copper could be. Look at Shanghai inventory levels from June of this year to where they're at now. They're down like 70%. So they're going to have to backfill that inventory at some point in time, right? And that's going to be a drag on the, when I say a drag, that's going to drag on the international production markets. The flip side of that is if you actually look at production levels for this year, even though the narrative earlier this year is like we don't have enough, and if you kind of look at an expansionary story on a global scale, we don't have enough, but we're not getting that much consumption because China is what, 60% of overall copper consumption in the world, I believe. I think it's 60 to 65%. So the inventory levels in Shanghai, the physical inventories in Shanghai are hitting lows, right? You can make the case, yep, maybe a lot of people are selling it. You have a lot of longs being taken off for right now. If you go back in the history, it's a 3-cycle product. I think the 3-cycle, your area of resistance is 520, in my opinion, right? Usually that first peak is going to be that indicator. Usually doesn't peak and then make a new high and then make a new high before failing. But who knows? Things can change. You would have to have a robust China story in order for copper to get to $10. Oh, let's just say this, because we got to talk about time frames too. Could copper eventually get to $10? Yeah, right. Could oil get to $200 eventually? Yeah, I mean it could, but what's the time frame on that? I find it very hard for copper to get to $10 next year without that whole, unless the Fed is literally going to be completely blindsided by a 1978, 1980s reflation narrative, and you have a complete disaster when it comes to monetary policy here in the United States for copper to get to $10.
To be clear, I didn't mean next year.
Okay, yeah, no, that's what I'm saying. Time frames. Yeah. That's why I brought it up. Time frames.
I just see a big base, and like the bigger the base, the higher in space is how I learned it. So
yep. Hey, like I said, it could commodities for me. It's kind of like right now this thing is kind of consolidating down that $4 level. You break below that, you're looking at around 375 and some change for your next area of support for copper. I think that you do have a significant amount of individuals that are shorting it right now. I think you do have the potential for a pop for it. I just don't know if it's going to outperform silver. But yeah, anything can happen there. The fundamental side of it, if you're looking just at inventory levels in general, says, yeah, this could actually happen. And usually when you get to March and April is usually when you start seeing a ramp up in imports from China for China, right? To kind of backfill that inventory. You just got to get some of the slack. There is some physical slack that's in the market for copper. And I don't think that you can really, we got to get that slack out first before we can really see it pop. But copper is another trade. I'm right there with you. I look at copper, silver, beans. That's it. Oh, corn. You can make a corn trade.
You need to come up with a clever acronym for that.
Yeah, I'll have to think about it.
This is where Sam also this is where Sam also does things in a way that he does better than most people, which is okay. This just looks really good, And that's the thing that also does happen too. Is like I do agree with you, Sam. Like it could be something that's crazy. Once again, it's like, okay, Kevin's exactly right, and the Fed does have a tendency of getting behind the curve at times. Now, once again, that's why everything's so reliant on the Fed. That's why on here all the time, I know it gets boring to some people because I've had people write me like, you guys talk about the Fed a lot. Like, yes, because the Fed has everything to do with everything we're trading. And if the Fed gets behind the curve here and we start to get in a situation where, inflation starts to get out of control, let's say they start to raise their targets, from 2% to 2.5% to 3% or something. We also see unemployment continue to move higher. We also see growth continue to move lower. If these things continue to happen and the Fed has to continue to lower rates for some reason, it could be the catalyst for some of these things that you're talking about. Now, once again, I think it's far-fetched to see $10 next year. But it isn't like, it isn't impossible. Once again, 100% moves in commodities in a year, they do happen. Something like copper, could it happen? Yeah, it could happen.
Cocoa did it in like a quarter.
Natty just did it this year, right?
Yeah.
Backed off of it, but I mean, Natty was up. We were on Monday of last week, right? I believe. So I think so, right? So Natty was
Monday last week.
Natty was up 65% at that point, and that was before it hit like 410, it hit like 415 yesterday, if I'm not mistaken. 420 hit 420 yesterday. I'm pretty positive Natty actually did go over 100% year to date at some point. So anything is definitely possible. I wouldn't.
My data is showing it's closer to 200%.
Yeah, it probably is.
Yeah, very impressive.
I mean, it would be an insane move. Once again, like we're really pushing it here to say like copper moving 100%. It's a huge commodity. It's not like a normal thing to see something like copper move 100%. But I am saying, if we go back to, let's just go back to that massive setup. If we just look at the setup we were just looking at, and we just go back to quarterly, I mean, it's literally, you start breaking out of that zone, you're getting above $5, like you're really starting to target these things. And granted, the time frame is, that's the thing about big trends like that. The time frame is always going to be unknown. And that's the thing nobody wants to hear as a trader. Like, you want to hear the time frame is known. I know that this is going to happen within the next 6 months. I know that this is going to happen within a year. Time frame is going to be unknown. The thing is, you try to follow the trend the best you can. You have a wide stop and you try to take advantage of it. And that's the best thing you can do if this thing really does get above $5 sustainably. Just, we haven't seen it yet. That's the thing. Like, copper would really have to prove itself for me to get more bullish on copper at the moment than
I just think if you go back and study like the correlation between gold and copper, like copper is usually not far behind gold. And gold's broken out. It's hit several targets of mine. Now it's consolidating. I don't think copper's far behind.
Yeah, I think that kind of goes back to what I was kind of highlighting earlier, though, right? The dynamic has shifted as far as the China stimulus, right? If they go back to the old playbook, for sure. But if they're not going to go back, they're not going to go full force on the real estate front, which, you can make a case maybe they shouldn't, right? But if they might double down and just say, hey, whatever, just keep building. But if they don't, then that's where you kind of lose the demand factor for copper a little bit. I'm right there with you, though. Like, it's going to be, I think it will be a mover, right? And then it's also kind of, how do you stomach that trade as a trader? For those that are listening to us today, and nothing that I say is recommendations, but if you are able to stomach the actual futures and waiting for that, then yeah, by all means. Most people can't, right? Most people are not able to sustain that, let me hold this for 6 months, 8 months, or whatever in the futures. But if you can go to silver and say, hey, you got the SLV, the ETF that you can use, not the best proxy, but the only real proxy that you got out there, right? That's where you can go and buy a little bit of time on some calls, 6 months out, buy some calls, sell 5% out of the money calls against it weekly, and just kind of just take in pennies, bringing in pennies. And then once you get your spike higher, that's when you take that off and just let it ride. So I feel like that's the ability to be able to be a little bit more flexible. With the copper trade, it's kind of like, what if you do break lower, right? What if you do break $4 and you break down to 375? I mean, 25 cents is that can do a little bit of damage if you don't have enough capital in order to hold that contract. But I'm right there with you, and I think the China trade is something to be there. And once again, I think the oil trade the oil trade is going to initially get a pop, and then once you have sustained prices, or if you do, I think that's when you're going to get supply coming back online. Other side of that, I think if we break 65 to the downside, I think it's really possible for us to actually hit $45 in crude next year. I'm not going to say that I'm not bullish on crude right now. I think the technical setup on a monthly chart kind of points to do or die right now. Like, hold up, push higher, and or if you break down, you're gonna break down hard. And that's kind of where I'm at right now. You can kind of see the hinge, and you can say, okay, yeah, maybe you do see a nice little pop. Once again, I think the supply factor there, they're going to try to put as much supply in to be able to meet demand as possible, because a lot of the smaller countries in OPEC Plus hate this policy. They hate this policy right now because a lot of those countries, 75%, 80% of their total GDP is selling petroleum products, right? So you constraining their ability to increase output is actually hurting them economically. For the citizens within their country, right? And so they have to kind of be mindful of that. But yeah, you have that shelf there, and that shelf breaks down. You're looking at 45. And actually, I have to look. So don't really quote me on this. I would have to look, but I believe because we've been below that 200-week moving average for so long, I don't think that there's a time over the last 30 years that we've sustained below that 200-period moving average for the weekly for so long, and us not actually fundamentally breaking down, right? This would be the first one that we would actually sustain and be higher. Yeah, you can see that. Like, there's not usually a time when we actually break below the 200-week, stay below it. I mean, we're going on probably week 14 now, 13, 14. No. Yeah, I'll have to look. I think we're probably at around 10 weeks to 12 weeks right now. I don't think you go in the past, we haven't broken down that 200-week for that long without us actually flushing. So the technicals and the history tells me be very careful about it, but you could say, hey, first quarter, first 90 days, there might be something there. And until you get that fundamental breakdown, I think I'm more of a proponent that you still scalp. Until you can break above 72 and sustain above $72, you scalp it. You buy at 67.50, you buy at 67, you sell at 70, 71, rinse, repeat. Until it actually has a confirmed breakout on large volume above 72 and remains there, I think you still play that range. Be mindful too. The last week, volumes for crude has not been that great. Low volume, low liquidity is easier to push prices either higher or lower. So it still hasn't really proved itself until we actually get some traders back into this market to be able to suss out what the actual price action should be.
No, I like that thought, and there's a couple things about it, and I'll just say this: when you're looking at a downward sloping 200-week, absolutely, I agree. It's very tough to trade a downward sloping 200-week moving average, but this is an upward sloping. Sometimes that can be just enough of a catalyst to say we are still in some form of an uptrend. Now, once again, even the signals we're talking about, we really want to get above that 200-week moving average before we get very bullish. For me, I'll just tell you guys straight up what the position is going to be. Right now, we have our reversal model as long it. And then for the trend model, it would be a half position above 76.69. We would go to a full position above 80. That's exactly what I would do with this trade. I think it's something to take a swing at if you are looking at oil, but I also don't think, I agree with Kevin in the sense of we really need to get above this entire zone before we get long this. This zone here is major resistance, major chop. But once we get out of it, there's a possibility of going a lot higher. But once again, that's a big what if. We have to get out of that zone. There'd have to be a lot of factors that would boost us out of that zone. and then it could possibly move higher. But for now, I think, targeting the 200-week moving average, and then possibly targeting the top of this range would be how I would trade it at the moment.
23 weeks below that 200 week. Now, the 20-week moving average is below the 200 week. That's a bear cross that actually occurred back in August. But today, if we close where we're at right now, this would be the first close above the 200-week moving average since July 8th. So maybe once again, kind of you're at a rock and a hard place right now. I think you play that swing until something shows you otherwise. For now, heating oil too. Look, heating oil up 0.8% right now. Two things when it comes to heating oil. One, that actually did break out above its 20-week moving average last week. It has some follow through right now. Your next area of resistance is going to be $2.42.5. And then let's see if that's going to push up. That's got the seasonality factor. It's got the weather factor, right? Natural gas popped because of basically the weather report that came out for the next 14 days, Arctic blast. There's also you got the EU Russia situation. There's going to be a pipeline that's potentially after today will not be supplying natural gas. That was another thing that kind of pushed it higher there yesterday as well. But look at heating oil. Heating oil is oversupplied right now. A lot of shorts in there right now. Technical breakdown. It broke down a lot earlier than any of the other energy products that are out there. Well, if you're looking at gasoline or even just crude, broke down a lot more before. I still feel like that's going to be your telltale sign that you get a breakout. That's going to be my thing. Now, heating oil is already kind of broken down, right? But I think that's going to be your telltale sign. Here's a nugget for people that are watching here. And it's a really key nugget because we just talked about inflation. You can go to FRED. So FRED is the Federal Reserve, economic database by the St. Louis Fed. I think they have it. So you can go to the Fed, make a chart. I don't have the chart offhand, but make this chart. This is going to be a huge win for you guys because you talk about the inflation trade. Make a chart year over year, or you can do month over month, depending on how you like it. I like looking at month over month, but you can look at year over year. Look at year over year change of diesel versus CPI headline. Do those two comps as far back as you possibly can and tell me that heating oil is not your actual leading indicator for inflation, because it is. It is. Put this on the radar before you even had the inflationary pump. This was back when we had the Russia-Ukraine conflict and all that stuff, right? Heating oil or diesel, we're going to use those interchangeably, is your real leading indicator that inflation is going to be coming back. The rate over month over month, or you can look at year over year, rate of change for heating oil starts to creep higher. You're going to see inflation move exactly with that. That's your key indicator for next year. If the Fed's going to have a problem, heating oil or diesel is going to tell you, especially given the fundamental dynamics, too much oversupply. So if you have oversupply right now, that should be depressing when it comes to price, or compressing price right now. Heating oil is actually breaking out. You already got that there, right? You can call it a bear flag. It's trying to break out of the bear flag to the upside. So it's got some areas of resistance, but that's going to be your key. That's going to be your key one to say, oh, okay, we might actually have that reflationary trade here. And that one is actually, I would say, probably the best leading indicator for inflation out of all of them. Better than gasoline is, because you have both the retail or the personal consumption, the individuals like yourself and myself, right? When it comes to gasoline, but diesel is going to show you, hey, is consumption also increasing for transportation? Diesel is not only the trucks on the road for the intermodal freight. Diesel is also going to be your locomotives out there, your UNPs, your CSXs. You start seeing increase in demand for whatever reason, increase in transport demand. They're going to need to draw on diesel fuel a little bit more. There's a lot that's kind of packed into this. So I'm still a believer that's going to be your leading indicator moving forward. Maybe I can try to build out a chart, but that's one to be mindful of here. Nice little breakout, but it still has a lot of work to do.
Oh,
What do you think about
absolutely.
following cattle for a kind of a leading indicator? That's been really valuable to my process. Live and feeder
Hey,
cattle.
Sam, your mic, something happened to it. Try again.
Can you hear me now?
Yeah, I don't know what's going on with your mic. It's like sounds like it's doubled up. But yeah, so just looking at heating oil, I agree, Kevin. It's got a lot of work to do. And I think the thing that if you guys go back to videos on YouTube from Kevin and I, the first video we ever did on it was basically to, look at the options on the oil market and basically start to buy them because of the impending events that were happening earlier this year. And so what we talked about on there was diesel, and diesel runs the country, it runs the world. Of course, it's a really good inflation indicator. And once again, like I always say, like I'm always posting things on heating oil. Kevin's always talking about heating oil, and nobody trades it, and nobody looks at it. I think that the big thing that will make people a lot better at trading is just having all these commodities on your board to make a watch list, take a look at things like heating oil, take a look at the commodities like copper, look at these things every day. You get a good feeling of like what's going on with inflation, what's going on with global growth. Oil and copper are kind of a growth and inflation indicator. Kind of when the world is running hot, you'll see oil and copper moving up together. So I think Kevin's absolutely right. If we're looking at next year and we want to continue to pay attention to things, heating oil has to be on the top of your list. Copper has to be on the top of your list. And just keeping an eye on inflation. I think the bonds are really trying to say something. I mean, they've been trying to say something all the way back when the Fed started to cut rates and they just went the other direction. I mean, TLT looks terrible. I have never, the whole time we've been trading the markets, and this is anybody who's listening for the most part, unless you're over 70 years old, basically. The whole time we've been in the markets, we're basically have been seeing this uptrend in bonds. Every time there's a dip, you can just buy that dip, and usually it will go back up over time. This is the first time that it just can't find its footing. And I'm wondering, Kevin, do you have any thoughts on, the reason is, do you think the reason is that maybe the economy is looking better than people think? Do you think it's just based on the S&P yield? Do you think it's based on inflation? What are you thinking for bonds? Are they ever going to go back up? Should people start to look at these things? Or do you think it's trying to tell us something about growth, inflation, or otherwise?
That is a good question. So I'm going to send you that chart real quick because I just made it. Look. All right. So this depends on your time frame. We were talking about trading it. Are we talking about putting it?
Generally,
here's my thing.
So
generally, I think that yields are either they're one, backing out rate cut expectations for next year. I think that's one. Two, yeah, I think there's also uncertainty of what's actually going to happen with fiscal policy next year as well as monetary policy. Boom. So that's going to cause you a little bit of concern there. Three, you also have the growth out, the growth that you have seen in the United States, and it's better than everything else. So why hold treasuries when you can get higher yield, rate of return on equities or looking at other places of the market? And then you also have the dollar too. You have a very strong dollar that's paying a healthy yield if you're kind of looking at very large institutional money flows, right? Where you could park something in a money market and get paid a pretty handsome amount for right now. I am not too concerned about yields getting to 5%. People are forgetting that the Fed put is still in place. If it gets out of hand, the Fed will come in and take care of things. And that's where I kind of rely on right now. I think the rate of change that we've seen has been fairly aggressive, but the equity markets for the most part right now have been able to hold up. You could also have this bond vigilante thing that people are kind of talking about right now, right? Where people sell yields, they try to put pressure on the Fed by selling yields and saying, hey, there's a problem. And then the Fed's going to say, okay, there's a potential problem here. Yields are way too high. Credit spreads are going to get blown out. We got to take action and start cutting rates. But if I'm looking at the TLT, you could say, yeah, it looks bad. Definitely does. But you're kind of getting close. I actually think that the TLT right now actually does look attractive. And I think that you don't go in there and potentially buy the TLT right now, like actual TLT, if you're putting it into a stock portfolio. But I do think that you could take a shot on the options and wait for that pop, because there will be a pop. Yields will go lower eventually in 2025. So what you got to do is be able to buy time. I'm not saying that they're going to end the year lower, but over time, something will happen where people are going to buy yields up again, in my opinion. And I think that's how you kind of play that. And so you can go out and look at the, this is not a recommendation, but I like getting a little bit of time. You can go out right now, look at the October 2025 expiration for the TLT at the money right now, sitting at around $5.50. Could you take a shot for $550 of risk and 10 months worth of time? Could you take a shot that TLT actually does see a little bit of a retracement and try to profit? I think you could. Not a recommendation, but I think you can make that case. Yes, it's not a good look. You also have to look at it too. That dollar is strengthening, and the dollar yield relationship is a very, very strong correlation. You're talking about an 85 to 88% strength as far as the correlation there. So you can say, okay, yeah, I mean, they're moving in tandem. And I will back to my dollar thesis. Could the dollar move up another 3 points from here? It could. It could. Do I think it's going to sustain at those levels? No, I don't. I think that the Fed will take action beforehand. I think the new administration will try to take action beforehand here. Could yields be saying, hey, higher for longer? Yeah. Inflation being an issue? Yeah, I can see that. But I think there is a risk reward setup, in my opinion, that you could take a shot at TLT. I wouldn't do it with TLT outright. I would actually probably just look at the options and just buy a little bit of time and look at it and say, hey, could I risk $550 to take an upside shot? $5.50 on this, on $87.58. You're looking at what, 93 and some change for that to be in the money. We were trading at 93 3 weeks ago for the TLT. Could you take a shot? Yeah. Could it go lower? I mean, your true area of support is sitting at 82.5. You could wait and take a shot, get a little bit of cheaper basis here. But I don't think if yields are acting in the manner that it is right now, and it's July or August of next year, I don't think I think the Fed will actually still take action. Unless the economic growth is really that great. And if the economic growth is that great, then you stay into the equities. Then equities should be able to perform. So that's how I look at it. What do you think? You say fade it here? And you can make the case to fade too.
I'm not saying either way. Once again, it's for me. It's really awesome to be a trend as a trend follower. For me, it's just like, hey, I'm just short. It's obviously in a downtrend. Is it sitting at support here? Could it bounce here? Sure, of course. However, it's hey, this has been in a massive downtrend for years. We've only had one buy signal that entire time in the long bond. Short bonds look very different. That we can see sometimes that we want to be long the short bonds. But if we're looking at just the long bond, we're looking at TLT. I just can't see a reason to get long it yet. However, I do like your idea. If you are a person, because there are people who are going to always want to buy bonds. And if you are going to take a swing at it, I think what Kevin said, and obviously that wasn't a recommendation by Kevin, but what Kevin said is the way to play it. You play it that way. You use it like it's either, even if you're buying it, you're basically thinking about it like a call option. Could it bounce here? Absolutely. It doesn't mean it doesn't. It can't.
Can you bring up a max chart?
The what?
A max time frame chart, or if you go last 20 years, because it started trading in like 02?
02, yeah.
Here's what I say, like, take a shot. Don't sound sexy right now. If you kind of go on the longer time frame, going back to the $82 level, I mean, how many times have we gotten down and touched that? Or even 81 and some change and bounced off? Maybe they're short bounces, right? But we are getting into a very close area of support on the longer time frame that I think would hold. I think any further deterioration or breakdown there would actually probably see the opposite reaction, right? If you see any further deterioration in yields, and let's say yields go up to 6%, 6.5%, then why the dollar probably will break its correlation and start going lower. There would be no reason for the dollar to continue to maintain its strength if yields are going to be so weak, right? That would be kind of a little bit of a contrarian trade. Yeah, you got the was that yeah, 10
That's a 2-year
futures. The 2-year, okay,
Yep.
2-year future. Yeah, all right. Yeah.
I mean, it's tough, right? Like, I think that's the main thing here is like, I would just, if you're already short it, like someone like me, great. Hang on to your shorts. Great idea. You want to get long it. It's a very tough trade. I'd wait for some upside, some momentum before you're really going to buy it. If you're a person who's just like, hey, I'm going to buy bonds for the next 40 years, great, go ahead. Like that's the different time frames. If you're like I'm a 6 months to 1 year trader. I'm looking at shorting the bonds, the long bonds. Great. I'm going to hang on to that one. You're in the very short term time frame. You're looking for a bounce. Maybe you want to buy it. You're in a very long term time frame, a retirement account. Maybe you want to add some bonds to it. I wanted to ask you another thing too. Have China has been pulling back on their bond purchases. Do you think that's any sort of a headwind? I see they're moving out of bonds quite a bit. They're moving into gold. I wanted to ask you, do you see that as any sort of a headwind, anything that could affect our bond market? Our bond market is huge, so it might be a no, it might be a yes. I'm just curious to hear your point.
Yeah, look, so China has actually been reducing its bond purchases from us over the last, 7 years, 8 years. And actually, they're not even the biggest holder of our treasuries anymore. I believe it's actually Japan.
Japan, yeah.
Yeah, so they're not like they're still. If you lose their flow, yeah, you don't want to see their flow going anymore. But they don't. It's not like they could. It's not like it used to be. Let's say that, and I'm not really too concerned about that. The gold move for them, I think it's more of a currency hedge that's taking place right now. Right, they're going to be a little concerned about potential tariff policy, maybe even some sanctions. And gold's really the only way for them to be able to hedge that with some actual physical currency. And China's really not on board with the crypto side of the equation, right? Like Russia kind of like hated crypto, and now they love crypto. Where China is still kind of skeptical when it comes to the crypto trade. So I think gold is the only route that they really feel comfortable in for right now. But now I'm not concerned about it. The big problem that you have with the treasuries is if Japan stops buying, because or if Japan starts selling their holdings because they need capital. That's where the yen carry trade thing came into effect. I don't know if people really understand. Like the yen carry trade wasn't like, oh man, there's massive risks on the books for a lot of institutions. Yeah, rightfully so. But the problem that they have is, does the yen kind of get too out of control, too weak, where their central bank actually has to either raise rates, right, and disappoint their own consumers, or do they start selling their holdings, getting cash in dollars to try to stabilize the currency? That's not what the U.S. wants to see either, because that could put some upward pressure, especially when you're looking at the long end of the curve there. So I think Japan has a bigger risk for our treasury market than China does right now. Even though I'm not going to discount, China still has some power, but not as much as it did, 10 years ago, 15 years ago, where you could have literally the threat of just like dumping treasuries and just creating a whole event because they're upset about a certain policy. That's just it's not as big of a risk right now.
Well, remember going back to 08, that was a big thing. China was talking about dumping their treasuries and how they could hurt the United States. That was a big thing kind of behind closed doors. So, you're absolutely right. But moving forward, yeah, I would say Japan's probably a bigger risk, especially with the situation with the yen right now. So let's also just talk about crypto, because nobody's talking about it now. Funny enough, I remember you said something. This is funny actually to bring up. Kevin was over here saying, "Hey, look at natural gas; it's outperforming Bitcoin," and everybody, was like, "Oh, you're just salty. You don't own Bitcoin or something." And that was literally right at the top of Bitcoin. You know, I said the best trade in energy was natural gas, and it's still continued to be awesome. So,
Yeah.
you know, talking about Bitcoin here is probably timely because everybody's kind of moved over it. You know, the people who are mad and hating on it, you know, nobody cares about them anymore. Nobody cares about the bulls anymore. So it's kind of getting to an interesting sentiment zone for me, considering how high it is. Looking at the COT reports, basically seeing that the commercials continue to just buy this thing like crazy, especially if you're looking at the micro contracts. The mini contracts and the normal contracts look a little different, but they're still buying. The micro contracts are heavy. That probably means that it's a lot more smaller commercials and smaller speculators than you'd think. So, Kevin, what do you think about Bitcoin? Think people are? Think it's going back to 100K? Think it's going to crash? Think we're going to get an 80% drawdown? I am wondering your points because we haven't even covered Bitcoin in like forever.
Yeah, and I usually don't like, you know, full disclosure. I don't follow Bitcoin. I'm not a believer in it. I'm not a hater on it. Because it's done a lot more than I would have ever expected. But I'm really not a believer in it either. Because like kind of think about the premise. It's like, you know, you're still converting it to any other fiat currency, right? And until you actually get the expansion of the utility itself out there in mainstream, which it's not right now, in my opinion, then I think it's kind of it's a liquidity pool that people are just play in. That's actually the best thing I can say. It's just a pool of whatever you know, like, look, dude. So every Christmas, what we do a gumbo for Christmas, right? And so if you don't know what a gumbo is, right, you have all of these different things that you can put into a gumbo, or think about it as like a stew. You know, you can go into your fridge and say, hey, I got some celery here, I got some carrots here, I got this, that, and the other, and I'm just gonna throw everything into this, and we're gonna mix it around and then just eat it, right? And everybody, there's no, you know, central way of making a gumbo. There's no central way of making a stew. I feel like that's actually what crypto is. Crypto is just a whole bunch of people that are just trading against each other, and it just happens to go up or it comes down, right? It's like a liquidity pool. That's the best way I can put it. I don't see the long-term sustainable move for crypto until you give me my debit card that has the ability for me to swipe and I can pick whatever funding route that I want to go in, and everybody is accepting it, and Visa and MasterCard and all those individuals, which, you know, crypto people want to get away from. And until that actually happens, I don't see any utility in it for developed countries. For the United States, we're looking at the Eurozone. Now, if you kind of look at it and you look at Niger, you know, or some country that's in Africa that has hyperinflation, their currency is going to crap. Is there a utility there? Yes. If you look at Brazil and you have economic turmoil there, or whatever, coups or whatever, is there utility there? Yeah. But outside of that type of application, I don't think that there's really a utility there. Not a hater. I think technically you see a pullback coming down to around 75,000. I think you do get another retest of that 100,000. I think you actually continue to see further appreciation of Bitcoin for next year, which is, once again, I'm kind of like balancing this out. You get a further continuation going into next year because we have a grifting environment right now. And if you were going to back Bitcoin or crypto with policy, US policy, or a reserve currency, that's hard to fade it anytime that there's a new market that's being supported by federal government. You can look at any market throughout history. Once again, you can look at locomotives. You know, it needed government funding in order for it to sustain itself. Telecom, same way, in order to sustain itself. The internet, for the most part, in order to sustain itself, especially to expand in rural areas. You name it, any type of new material thing or technology that's supported by the government probably is going to continue to see positive inflows for now, until there's like a rug pull and Satoshi or whoever owns like a whole boatload of this stuff rug pulls everybody and creates a crisis. So I think you still get positive passive flows in there if you do get the actions from this new administration that they talked about on the campaign. But I think structurally, I think you see a pullback in 7,500. And this just goes to say, it does not matter what you trade, it's how you trade it. That natural gas example, I find it to be funny because no one cares about Natty, even though Natty has more of a utilitarian application in the world these days than Bitcoin does. But no one cares about natural gas. You can look at that and say the same thing for water.
Yep.
No one cares about water, but it's the most precious commodity that we have on this earth. And
we all die without it.
Yeah, exactly. and water utilities, which I wrote about earlier this year, for the second half of this year, water utilities are up around 20 to 25%, which is something you never see. So it's just kind of like, hey, find what you like to trade, stay in your lane, and just trade it. If you're making bank off Bitcoin, by all means, go ahead and do so. I ain't hating on your hustle. I just can't hang out with you in that space, right? And a lot of people can't hang out with me in a natural gas space, or if you're looking at a crude oil, there's markets for everybody. Champion the ones that you have an interest in and that you can trade in and profit. That's all I care about. But that my high level thoughts about crypto is I'm not really a believer in it. And probably I won't ever be. And that might just be the millennial in me, dude. That might be the 34, about to be 35 this year, starting to get a little bit older, right? Like that just
getting stuck in your ways, dude.
Yeah, I'm starting to get a little grumpier these days, So that could be the case. But when I see Fart Coin up 150% or whatever, or
it's hard to be a believer when you see
Butthole
stuff
Coin.
Like that.
I thought somebody Butthole Coin actually was up like 1,500. When I start seeing that, it's like, all right. Do you really think I'm going to put my hard-earned money into into an industry that's got I don't want to say clowns, but has that type of behavior taking place? And I think that stuff is funny and people profit off of it. But I think people, especially the crypto bulls, have to understand that type of behavior is also puts like a negative light on it as well. And if you really want true positive retail retirement flows, institutional flows, you got to grow up a bit. Like, the stuff's kind of a joke, but for every one coin that I've seen pop to the upside and actually sustain itself, you see 100,000 of them that fail. And some of these things, hold up. I literally read that this morning. This is the funniest thing I've ever, this is how crazy this situation is. So there was a guy, I don't even know who this dude is. I just saw the post. Right? And it's so funny when you see people get rug pulled by the Haktua girl and all this stuff. It's so funny to me. But somebody invested in something called Burnt Coin. Burnt. Okay, you put your money into something that's literally telling you that they're going to F you over. And people do this, and then they're like, oh my God, I can't believe I got rugged. The thing is literally telling you in the title of the actual coin, burned. You're going to get burned out on this thing. And then people are like, oh, I put $35,000 into this. Like, dude, Darwinism, when it comes to financial markets, has been lacking for the last 10 years. That's here's my true feelings. The Darwinism aspect has been lacking so much. People buy dips on everything they possibly can. They don't think this market could go down, and people are stupid enough to put their money into something that literally tells them that they're going to pull the rug on them, and then they get all like sobby. Oh, I need to raise money. That was my college, my son's Coverdale and 529 plan. It's like, dude, what are you doing? Like, you probably should not be trading. And that's
it's part of the reason why you and I do this, is to tell people these situations and to talk about like real trading, how it works. Like I love crypto, not because I love, the actual thing or it's going to go up forever. I just love the liquidity of it. It's easy to trade. However, I don't go out of my lane. Everybody's like, oh man, did you buy the new blah, blah, blah? I'm like, no, I'm trading the Bitcoin futures with a trend model because there's no other way for me to make money on it. The fundamentals behind it, I can't say, oh, the fundamentals are great. What fundamentals? I can't say when it's going to crash. I can't say when it's going to go up and down. I can run a trend model on it that makes a lot of money. Yeah, that's it. and it's the same thing. Like, sure, like you can see types of manias I've written about, being in the one of the first ones from 2015, 2017, and somebody threatening to kill me and all this stuff. Like, sure, you can see mania, but that's like a one in a million chance that you're gonna actually hit it and sell it right at the top or something. You have to have some sort of model, some sort of exit strategy for every trade. That's not to do with just Bitcoin. It's like, if you're gonna, and this is a thing that bothers me about technicians. If you're gonna say you're a technician, you just follow the price. It's like, okay, dude, follow the price. Understand that, trade it all the same. Whether it's Bitcoin or whatever, you can trade it all the same. However, if you're a fundamental person like you are, which you understand those better than most people out here, it would be very hard for me to make a case for you to buy Bitcoin, especially when you got things out there like Fartcoin and all these other things. I find it absolutely, like, it's sad for me because I've been around this industry for so long. I was around the first time, and Kashap and I talk about this all the time, when people were buying the ICOs the first time. I have a friend who literally put $1 million into one of those ICOs, and he keeps his receipt just to like laugh about, like, because it went from $1 million and it's worth like $30, and you couldn't even get $30 for it if you wanted to. And like, they just kind of laugh about it, like, oh man, this is crazy. But like, they're still all crypto bulls. Like, I don't know one of those people who lost everything in crypto who said, I'm never trading crypto again. And they still buy the new coins out there. And it's like, the safest thing to do if you're going to be in that market, buy the biggest market cap ones, stick to Bitcoin, maybe one other if you really need to. Make it a very small part of your portfolio, make it a very small part of your trading. That's it, because it is the most volatile asset in history. And people are like, here's the other thing that's even crazier. That's all crazy what we just talked about. Here's what's even crazier. You can get 100x leverage on it.
Oh yeah.
You want 100x leverage on Fartcoin, man? You can do it.
I mean, yeah, I don't know. It's
crazy.
But you look at it and say, hey, okay, what's actionable here? Here's another actionable thing. Not a recommendation. If you're bullish on it, look at IBIT. You can go to IBIT, look at some call options, go out, get in some time, and buy one. Mm-hmm. Buy one call. Maybe that's your exposure. $1,200 right now for the 54 calls out for August. You can even go out and out for August. You can go out to the Jans for $16. You want some skin in the game? I mean, it can move. You want some skin in the game? That's how you do it. Go out there, buy a little bit of time. And people are like, oh, they're gonna say, oh, Kev, like those options. Yeah. People are gonna go, oh man, well, Kev, like you're buying at the money, you're buying so much time, dude. If you go back and look at the SPY, and you bought at the money SPY calls that expired in December today, and you bought those at the beginning of the year, or basically when the market ended last year, those were going for about what, $1,500. I would have to look again, right? $5,000. Actually, it was like $55 or something crazy like that, right? If you look at those things have literally almost 10x, 13x actually. I was looking at it. Okay, outsized year. Look at the year before, and if you did that, same results, right? Small amount of capital, take a shot. Yeah, you're gonna have time against you, but time decay really doesn't take it, especially when you're buying that far out, really doesn't hit you until you get to around 60 to 90 days to expiration. If you want exposure, you could have that with a lot less capital to put up, a lot less risk to put up, and take a shot if you wanted to take a shot. And I'm not saying people go out there and just buy at them, but it is a thing where it's like, all right, what if you did want to take a shot? Mm-hmm. Or you can look at selling puts against it if you have a retirement, you want to do a CSET. Sell one put, that's it'd be $5,000 margin requirement. You sell one put, you can get the 55 puts right now, which would be 5,000 margin requirement for January of 2026. Right now, we're going for $1,300, basically $1,400. You could take in $1,400 worth of premium. You can identify and establish your entry point here if you wanted to. And if it goes up, you collect that premium and you can do it all over again, right? There's ways for you to be able to profit off of this and not have to be like some, let me look into doo-doo coin and all this other stuff. Like we don't, there's a lot better ways to do it. Yeah. I ain't hating on, I'm just saying there's a way to finesse it. And there's, that's how I've been like looking at the markets lately. It's like, why not? You could scalp every single day, and I love doing that. Like, it's fun for me. But if you kind of look back at it, and it's kind of like, I could have just bought a SPY at the money call and let that bad boy ride and 13x my money.
Yep.
Instead of scalping here and scalping there and looking at this trend line and that trend line. Sometimes time's just a better, it puts you in better favor of the market. And so that's my theme this year.
We
that's
need
my
to,
theme this year.
Oh, I like that. Yeah, that's good. Literally my same exact age as you are today is the same exact time that happened for me, and that shaped my trading and time frame forever. That's still where I'm at. It's just and not to mention, like, I think of guys like Jerry Parker. Like, he started out with, like, buying the old turtle system was like buying 50-day highs and selling 25-day lows, and like, constant trades, constant systems, constantly across all these different markets and futures. And now he's just gets more longer term as time moves on. Yeah. And so before we go, we got a second. We got some extra time with Kevin today. We have 550 people still in here. So on Twitter. So if you guys have questions, feel free to ask. If you don't have any questions, we're going to take off pretty soon. But I'm sure, like, you guys have some questions. How Kevin makes his gumbo. If Kevin puts any silver or gold into his gumbo, to eat it. Whatever. If you guys have some questions. No, I'm not kidding, though. I really like the crypto gumbo reference, like the liquidity pool. Like, that actually is, like, it's pretty spot on.
Yeah, it's just how it is, man. Look, some sectors I'm looking at for next year. LNG, once again, I still think it's an infrastructure play for next year. Looking at once again, not a recommendation, but companies that have some exposure like BKR, Baker Hughes. We'll get to this, some of the equity stuff that I know people love. Baker Hughes, which has had a pretty decent run, but they do have some exposure to LNG, infrastructure, some turbines, things of that nature. Halliburton doesn't have that much exposure, but if you kind of look at a Halliburton chart and their ability to potentially be on the forefront of trying to expand, pipeline access and mapping out pipelines for the market, that could be another one. Yeah, Halliburton. Once again, it's kind of like, what's the risk reward there? So I've been looking at that. We already talked about the China theme. I think that's going to be a key area for me. I still think that there's some pockets of opportunities in the staples once they kind of pull back just a little bit more. I still believe that the small nuclear reactor, modular nuclear reactor story is going to be one. I talked about this and I posted this yesterday. Thorium is versus uranium. I think there's opportunities to kind of diversify the energy revolution that we're going to see for AI, right? And uranium is very popular. That's the nuclear side of it. There's also something called thorium, and that's something that's been tried over the last 30, 35 years. There's some technical issues with it, but China over the last year actually just booted up a thorium reactor to try to improve the concepts there. And the reason why I bring this up, the uranium trade, I think, is still going to be a 2025 theme. I wouldn't get away from that. We've talked about the supply constraint that we probably will see at the latter half of next year. If the Russia-Ukraine conflict does not get better, Russia probably will cut off our supply. They're pretty much doing that right now. It's not going to be an issue today, but it will be an issue down the road. But if you kind of look at the longer term trend, let's say that we start having these type of relations where uranium supply or obtaining it becomes a lot harder, right? What's going to happen? Prices obviously are going to go up. You have companies like CCJ that will benefit from this, definitely. But you got to start thinking about, okay, well, what is the alternative routes? And thorium is an element out there that's really readily available here in the United States and pretty much around the world. And that could be another alternative source if we're able to perfect that. And so that's not a 2025, only in 2025 story, but I think that that's more of a start hearing more about new technologies in the utility space than just small modular nuclear reactors, right? I think the fracking and geothermal fracking story next year is going to be a bigger theme coming into play. So I think you got to be a little bit more tactical when it comes to the utility trade, but I still think that there's pockets of opportunity there for now. And then it's hard to kind of get away from the tech trade. You have 40% of the returns are, 30% of the index when you look at the S&P 500 is going to be the Mag 7, Mag 8, whatever you want to call it these days, right? If you're bullish on this market, the only way that that's really going to sustain itself is unless you get massive outperformance from the other underloved 493 stocks out there, is to still have exposure to the Mag 7. So I think that's something that you can't live. You got to kind of live with the concentration for right now, and I don't think you can really fade the concentration. I hate that we're that concentrated, right? But you can't really fade that. So I think you still have to have exposure to the Mag 7 names if you are going to be a bull in this market. But yeah, so those are some of the key areas. Oh, and then wheat.
I wanted to talk about this 1 second, just to add on to what you were saying. Semiconductors, I continue to highlight this squeeze pattern here. Once again, we don't have a direction yet. We needed to break above a level or below a specific level. But that's a trade that if you are bullish on it, you could start buying some options, some call options 6 months out, 3 months out if you're very bullish short term, or put options. I would wait for it to really clear some major levels before doing that. But that's another one that we're looking at. So, Kevin, you were talking about wheat.
Yeah. So Ukraine's actually sending wheat over to Syria. We wrote about that about 2 weeks ago after Assad and that regime fell. I think you're going to see a supply shift. I think Ukraine's going to make a play to try to expand its presence within the wheat market, especially when you're looking at Middle Eastern supplies, which I think the EU would actually be favorable of right now, because the EU really does not want Ukrainian grains in their markets at all, because it's going to push down prices, and farmers don't want to see that and things of that nature. But I think wheat is another story for 2025 to be on the radar, just because of the shifts of the geopolitical risk that's out there. You did get first notice day today. So you had soybeans actually up. They faded a little bit. Soybeans were up like 1.5% in the market. I think there's still some headwinds. About 0.8%, still decent. Corn up about 0.9%. The grain trade is still going to be very difficult, but if you get that tailwind of energy, kind of getting that initial pop, I think you also kind of get a little bit of a pop when it comes to the corn trade. That'll be the ethanol side of the equation there. And I think you had a chart about this, that it's I say potentially breaking out. We got to see if it's going to sustain. But right now it does appear that it has regrouped for now. But I think you have to continue to see follow through and get above these current levels, get above that 475-ish area for corn to really kind of feel comfortable with that bounce back. But it actually has had a nice little, let's call it a short covering rally for now. And then also export demand for corn has actually been a lot better than what the market has expected to. So it actually has broken up a fundamental downtrend too. If you're at a weekly chart, you put up a 10-year weekly, you can see that there was this triangle pattern that was taking place here. It actually has broken above that. So that's another one to keep on your radar. And we have El Nino risk this year. We have El Nino risk this year, if I'm not mistaken.
No, and I'm really bullish on corn out of all of them at the moment. I do think corn has the best setup still. Soybeans also do have a setup, though, just the chart looks like crap. But as we continue to see confirmations on the charts, we'll continue to update you guys. For me, I'm long corn right now. I have not gotten long soybeans. I've not gotten long wheat again. Wheat is getting closer to a buy signal. I also agree with Kevin on the fundamentals on that one. And I actually just wrote a post on all the grains just last week, just kind of going over wheat, corn, soybeans, and why 2025 could be a good year for the grains. So, all right, guys, we'll let you go. Sorry, business person, that you just caught up with us for the first time and we're leaving, but we're always on at 11 a.m. Glad to see you, though. Please check out the replay. It's always on YouTube. So, all right, guys, thank you guys for joining us. Have a good 2025 and a Happy New Year. Take it easy.